A corporation may distribute cash to stockholders in the form of dividends. This video will explain how to account for cash dividends. Pro rata simply means that if you own 20% of the stock, you will receive 20% of the dividend. For a corporation to pay a cash dividend, it must have retained earnings. Payment of dividends from retained earnings is legal in all states. It must also have adequate cash. And lastly, the board of directors must officially approve the dividend. As soon as it makes the declaration, it creates a liability. There are three important dates: the declaration date, the record date, and the payment date. On the declaration date, the board of directors announces the intention to pay the dividend. The declaration of a dividend creates an obligation or a liability for the corporation. The stockholders who own the stock on the date of record will receive the cash dividend. On the payment date, the company makes the dividend payment to the stockholders on record. Companies make accounting entries on the declaration and the payment date. No entry is required for the record date. To illustrate cash dividends, let's assume that on December 1st, KEB Incorporated declares a 50-cent per share cash dividend on 100,000 shares. The dividend is $50,000, and that is found by taking the 100,000 shares and multiplying that by 50 cents. In previous chapters, we used an account called dividends to record a cash dividend. Now we will use the more specific title, cash dividends, to differentiate from other types of dividends, such as stock dividends. The entry to record the declaration on December 1st results in a debit to cash dividends or retained earnings for $50,000 and a credit to dividends payable for the same amount. For your homework problems, use the cash dividends, not retained earnings, for recording dividend declarations. No entry is required on the record date. On the payment date, the company makes cash dividend payments to the stockholders and records the payment by debiting dividend payable, or $50,000, and crediting cash for the same amount. Cash dividends cause a decrease in both assets and equity, or more specifically, retained earnings.